but this was even evident prior to COVID, but COVID really solidified it more intensely. I suppose the sentiment on the ground, even before COVID, but more importantly through COVID, is food retail, because of its essential nature. And we saw and continue to see more and more investors actually adapting their strategies for food retail, i.e., Greenman's asset class. So grocers were the main winners, I believe, in retail through COVID, and will always work well throughout any difficult economic periods. The grocers, have very large increased turnovers throughout the pandemic. I think there was something like around 16% of increased turnover due to their operational status, that they were the only real retailers that could open their doors to the public. And when you have a fund like Greenman Open, where the main source of our rental income is being generated by food retailers, this will always remain a very safe and secure stream of income for investors for the long term. And lastly, with the high inflation market we are all experiencing right now, this works very well with our CPI indexation linked leases with our retailers, and therefore this can now also be seen as a further demand and interest amongst investors in the food retail market. Yeah, good question. So what we keep, this is obviously our bread and butter. We keep a close eye on this across the market, in particular Germany, and obviously throughout Europe. The grocers, in our opinion, as I said, were the real winners during COVID, seeing large amounts of turnovers. However, as the main parts of COVID are now over, there is now a shift in trends from grocery retailers. So it's clear, especially in Germany, together with other EU members, people are more now concerned about pricing. People are more concerned about pricing compared to 2021. Another sort of notable attitude is a decrease in shift in online food retail, and in particular with Germany and Poland, which was always, in any event, trailing well behind, the likes of the US and the UK for online food retail. But as I already, sort of alluded to, grocers always perform very well in difficult periods. And combined with the new attitude towards grocery shopping across most EU members, price sensitivity remains high, and I'm sure will continue to remain high in the course of this year, and in line with the high inflationary period we are all now witnessing. So people want to still come to the centres. They want quality, they want value for their money. And therefore, as we always have said it, no matter what is going on in the economy, the brick and mortar, that physical retail asset, remains very important, very relevant and sustainable for the long term. We are continuing to do what we do best, and that's buy food-dominated retail centres, in particular where the percentage of essential retail rent is high. Obviously, ESG is now becoming more and more relevant, and these types of properties are becoming a lot more important and interesting amongst investors, which is a really good thing. So it's not just your locations anymore, catchment areas, purchasing power, tenant qualities. But ESG is now becoming a main part of the investor's criteria when reviewing these types of assets. For example, a recent asset which we just acquired as part of one of our final properties in our first developer framework agreements ticks all those ESG boxes, as it would deliver a brand new REVA gold standard green building concept, and forms a great asset for Greenman Open, together with a 20-year lease contract with both REVA and Aldi, and 85% of that rent being generated by those two anchor tenants alone. So very strong property that we just acquired for Greenman Open there. You can't get any better than that in terms of ESG and income security for investors. I suppose in terms of our next deals and moving forward and looking ahead to this year, as the first sort of development style framework agreement has performed extremely well in 2022, 2020 and 21, we're in the process of hopefully entering into new framework agreements with leading German developers in order to secure more top quality assets for the fund. And I suppose to finalise in this, because we are now considered very high market leaders in our asset class, we've additionally been recently offered well over 400 million of new off-market deals, which combined with the framework agreements we do with the developers, will give Greenman Open a secure stream of pipeline until the end of the year. So pretty much we're in an excellent position to grow the fund even further. And after hitting our target and milestone of 1 billion of AUM by the end of last year, another asset class which is worth noticing as well, and which we are considering too, is we're looking at more of this food resi mix type of an asset, which is becoming more and more popular in Germany especially, and again a very good tenant mix and secure stream of income for investors. So that's something on top of the typical food anchored property Greenman will always look at. We are looking at that kind of food on the ground floor and multifamily on the upper floors as well. Personally, myself, I've been with Greenman now for over 12 years. Our saying has always been there are 83 million people in Germany and they all need to eat. Very simple. And thankfully, we did not have to wait for a global pandemic to realize the essential and secure nature of such an asset class. Our strategy has always been to buy food anchored assets anchored by some of Germany and Europe's leading supermarket chains such as Edeka, Rewe, Kaufland, Lidl and Aldi. That will generate that long-term consistent income for our investors as we are, a buy and hold fund. Our other main USP, I believe, is our strategy as an owner manager, where we do all the property asset and technical management in-house and on the ground in Germany. That has also proven to be a success. We've built the teams on the ground to successfully look after the assets, create that long-term value for our investors, and maintaining that long weighted average main lease term across the portfolio by building that solid relationship with the key anchor tenants, which has been brilliant. We now, I believe, have more German staff in the company than Irish, which is a massive achievement and gives us a great underground footprint to continue growing the fund to well over 3 billion, hopefully by 2027. I suppose, as we're now one of the largest funds in the asset class in Germany and only specialise in this asset class, this has also led to many off-market deals with some of Germany's leading developers, even the groceries in terms of sale and leaseback deals. This means we can always have a secure locked-in pipeline of properties at all times to balance with our bullishness in terms of investment pipeline and buy the best properties for Greenman. And I suppose lastly, to finalise, I just spoke briefly about the whole ESG and how that's becoming more and more important. With our new ESG concepts that we should be rolling out in the coming years, this will hopefully give us a cutting edge in the market and make sure our buildings are not just maintaining and adding value with asset management strategies, but also becoming more greener and reducing the overall portfolio's carbon footprint going forward. So basically watch this space. We have lots of these ESG initiatives coming down the line.